Good morning. My name is Liam Burke. I'm the Managing Director of B. Riley Securities. I'd like to open by thanking Nicholas and the Capital Link organization for putting together another impressive New York City forum. I'd also like to thank our panelists for sharing their perspective, and of course the audience for participating in today's panel. I'd like to start by introducing individually each panelist, and if I could ask you to give us a little background on each of your companies, just to give the audience a little perspective of how you operate. So I'll start with Mr. Anastasios Aslidis. He is the CFO of Euroseas Limited. Welcome and thank you.
Thank you for the introduction. Thanks to Capital Link again for organizing the conference. Nick, thanks one more time. I'm representing two companies. I'm CFO of both Euroseas and EuroDry. Euroseas is active in owning and operating container ships. EuroDry is focusing on the dry bulk market. We've been listed on Nasdaq for almost 20 years, Euroseas and EuroDry for 7, and I'll be happy to provide whatever I know about the container ship market today.
Thank you. Mr. Thomas Lister, CEO of Global Ship Lease. Morning, Tom.
Thank you very much, Liam. Thank you, Nicholas, for having me here, and good morning, everyone. So Global Ship Lease is rather like Tassos' company. It's an owner of container ships, so we charter, we lease a fleet of roughly 70 mid-size and smaller container ships to the leading liner operators around the world. So we're tonnage providers, and our goal really is to provide them with optionality in terms of capacity at these very uncertain times so that they can adjust their service networks to a very fluid environment when it comes to trade patterns. We're listed on the New York Stock Exchange, where we listed in 2008. We've got a market cap of roughly $1 billion, so still fairly small, and we pay an annualized dividend of $2.10 per share, which is sort of roughly an 8% dividend yield.
Thank you, Tom. And Mr. Bill Rooney, VP of Strategic Development at Kuehne and Nagel. And Bill, I'd like your company's logistics mandate is a little broader beyond container shipping. Could you give us a background of your company and then zero in on your activity in container?
Yeah, sure. Kuehne and Nagel basically started in Germany. It's based in Switzerland today. We were, until recent acquisitions, the largest, I guess you would call, freight forwarder, NVO. Our company has been the largest ocean freight forwarder, NVO in U.S. legal terms, largest air freight provider. We do contract logistics, over the road, you name it, pretty much we do it related to transportation. Company's been around for about 30 years or so. And as far as container ship is concerned, container shipping, we basically buy and resell. Our customer base is typically small and medium companies that want to transport cargo from point A to point B, basically anywhere in the world. And we buy from the vessel owners and carriers and resell to our generally small and medium customers, pretty much everywhere. For example, we have 1,400 offices around the world, almost all of them staffed by our own people. We don't use agents. I think that's a pretty good summary, and obviously we're very big in air freight, as I said, contract logistics, over the road, pretty much a full suite of capabilities.
Thank you, Bill. My first question is, container shipping is a sector that was built on free trade. With the development of protectionism recently, A, how is that affecting the business? B, is this permanent? And C, should investors be concerned about this? I'll start with Anastasios, and we'll just go right down the table.
Thank you. Undoubtedly, any mode of transport, especially seaborne, is relying on trade taking place and increasing. The introduction of China the admission of China to the World Trade Organization 20-something years ago changed dramatically the prospects, especially for containerized trade, for all trade, but especially for containerized trade. Obviously, any protection measures that result in reducing trade will not be good for us. It's unclear whether this late spate of tariffs and counter-tariffs and renegotiations, whether it has settled, and whether also it would indeed reduce trade. It might change the trade patterns, which might be good or bad, depending on how they settle, and it might reduce trade because people will find this a disincentive to import. So I think my short answer is there is still a lot of uncertainty on what's going on with the tariffs and how they will affect trade. And as Thomas alluded earlier, we're trying to provide to ourselves and to our clients, the liner companies, optionality in dealing with that.
Thank you. Tom?
Right. In shipping, and particularly if you're a provider of capacity to the space, as we are, disruption counterintuitively is good. It's good news. So if you move from an environment which we were in up until, a year or two ago, of big, fat pipes of cargo flowing principally out of China as the factory for the world into the big consumer markets for the world, you had a remarkably efficient supply chain. Now, on the one hand, that's good for the consumer because efficiency tends to breed low costs on goods. But if you're providing capacity into the space, strangely, it's not so good. What we prefer is a fragmented supply chain, an inefficient supply chain, a supply chain that requires more ships, more capacity to run it. So broadly speaking, disruption is good news, at least in the very narrow context of our business. Now, adding on to Tassos's remarks, whether this shift away from free trade genuinely undermines the movement of goods or not is yet to be seen. So if we look at global containerized trade volumes, they're still up year on year by between 4 and 5%. Now you can say that the proof of the pudding will be when the tariffs actually start to have a genuine biting effect on inventories and on the movement of goods, but so far we haven't seen that. What we have seen, again, to Tassos's point, is the beginnings of changing trade patterns. So China, for example, is seeking new markets, particularly in the global south. And I think Maersk said on their recent earnings call that they saw volumes up very substantially from China into Latin America and China into Africa. Now, once again, if you're providing capacity, this is all good news. More broadly than that, it's very, very difficult to say how things will change. We simply know they will change. Trade patterns will change. Maybe there'll be more regionalization, but we'll have to wait and see. So optionality is key in our view.
Bill?
A bit of a longer view. If you look at world trade from about 1990 until the Great Recession, it was growing at about almost 10% a year. Between the Great Recession, say 2008, and now it was growing roughly at 3% a year, which was basically a multiple of 1 versus global GDP growth. And I think most people are looking at the ratio going down, and the IMF forecast for global trade next year is 1.9%. So in addition to that, you have, I guess you could say globalization has not quite tapped out, but it's not growing like it was from 1990 until 2008. And I think the trade, there's already signs that the trade is obviously changing, has been mentioned. You're going to see more intra-regional trade, which is going to make a difference. I'm not sure. A big issue that we hadn't talked about yet is specifically, this is the tariffs. And the tariffs have had a dramatic effect on trade in and out of the United States. They will continue to, but they may yet be ruled illegal. The Supreme Court is hearing oral arguments in early November. And if they are ruled against, it may restabilize things and how trade happens and how the U.S. imports and exports. And I suspect, I think it's sort of even money about where it's going to go. My personal belief is that they'll be ruled illegal, which will be the 4th court in a row that will rule them as illegal, and that will change things significantly. As far as whether China to Latin America, China to Africa is ever going to, in the near future, replace significant volumes between China and the U.S., I think is a big question mark. I suspect not. And last thing I'll mention, relative to the business is we're still, for example, living with the Suez problem, which is sucking up 8 to 10% of the capacity. And when that is resolved, which it may be, based on what's happened in the last few days, maybe not until next year, but that's going to release another 8 to 10% of capacity back into the marketplace, which will be helpful, but it won't be helpful for the ocean carriers in terms, and I assume asset owners in terms of charter levels. If you have an additional 8 to 10% of capacity, which is going to be pushed into a situation which is already overcapacity and is expected to be overcapacity towards or into 28 or 29.
Tom, you touched on something. A liner company in the second quarter announced that the U.S.-China trade route was down 30%. They also went and said, well, there's been redirection of sourcing by the U.S. and alternative markets by China. Is this a negative, a net negative, a net positive, or is it net neutral as we see this redirection of traffic here?
Yeah, very good question. I think what I remember seeing is that in the wake of Liberation Day, various liner companies saw bookings and booking cancellations of roughly 30%. However, although that took place, as you say, Liam, in the second quarter, there was a remarkable catch-up in volumes thereafter. So I was looking at data for containerized trade from China into the US specifically, and this is through until, I think, July or August. I haven't seen fresher data, and they were up something like 8% over that period. So, this is a hugely disruptive year. It's very difficult to imagine how all of this plays out over time, and, I take a number of Bill's points over, how things may act over the long term. But I think it's useful to remember that the actual containerized demand, which is driven by demand here in the US, is roughly 13% of the global total. Whereas, to put that in context, intra-Asia, one of the intra-regional trades that Bill was perhaps more broadly alluding to, represents roughly 40% of global containerized trade. So the pieces can be moved around the chessboard quite flexibly. But I fully agree that the reopening of the Red Sea is going to be a seismic event, really, for the industry. At the moment, it's been roughly absorbing around about 10% of effective capacity. So if it were to open or reopen from one day to the next, that would add latent capacity into the market at the same time as the order book is flowing into the market. So in terms of supply-side pressure, definitely there's going to be potential supply-side pressure for the industry, almost regardless of what happens with demand. But I would temper that by saying it really depends where you're sitting in the supply chain and where you're sitting in terms of providing capacity. So not every container ship is created equal, effectively. And I would say that the mid-size and smaller ships, 10,000 TEU and below, are, number one, underrepresented in the order book, and number two, have been less impacted directly by the Red Sea. Both the order book and the impact of the Red Sea has tended to be focused upon the really big ships. So it depends where you're sitting, I guess, how each of these dynamics will play out.
Thank you, Tom. Anastasios, do you have anything to add to that?
Yeah, I think Tom touched upon the key challenge. Away from trade, which, again, uncertainty is what defines the trade picture right now. And supply side is our greatest challenge, and we have a huge order book that we have to absorb as a sector. And we have the Suez Canal issue that if it reopens, it releases more capacity, so it's even more of a challenge. I will reinforce the comments that Tom made about the distribution of the supply challenge. All the order book, now we should stop talking about the order book, I guess, but all the order book.
I was going to ask about that later, so go right ahead.
It is concentrated on large ships, 10,000 and larger. Smaller ships, feeders and intermediate ships are underbuilt. They have a higher percentage of their fleet over 20 years than is currently being built. So if anything, another interesting source of uncertainty is emerging, the overall fleet is going to be overbuilt, but certain segments, certain subsectors, the feeders, the intermediates, would be underbuilt. How this will play out to be seen. And then you have Red Sea releasing capacity against environmental regulations that potentially accelerate removal of elder ships or less efficient ships, which again happen to be on the feeder intermediate sector. So, an interesting picture.
Anastasios, I could stay with you. October 14th is a particularly interesting day today with the port fees kicking in. Obviously, we've heard from China retaliating. Operating vessels less than 10,000 TEUs. How does that affect your business on the port fee side? And I believe there's a sub 4,000 TEU exemption. How is that working through as we anticipate these port fees?
I think talking first about the US port fees, if that is what you...
Yes, it is.
I think we figured that of all of our vessels, both on the container side and on the dry bulk side, if I remember well, only a couple of larger dry bulk vessels that we have will be affected. To be confirmed later, but I think we feel okay with respect to the container fleet. We will not face US port fees. We were especially concerned over the weekend, and still are, about China's counter measure on that, with the port fees that they announced, which apparently are supposed to take effect today. And there it's, again, less clear what's going to happen. The preliminary information that we got and whatever we could get our hands on is that very likely a good number of, because the concern was whether public companies being listed in the United States can prove or not whether less than 25% ownership is US based. I think we have started feeling a little better with the various clarifications that China is providing that it might not affect companies like Euroseas. I don't know about my peers, but there are some clarifications that we expect to hear to hopefully confirm that.
Tom?
I mean, little I can add to that. You know, we're all interpreting the release of the Chinese regulations in real time, and I think it would be a brave man who said, okay, I've got a really good handle on how this is going to play out. I think in the case of the US fees, I would echo Tassos. I think for a start, the industry's had longer to adjust to it. The liners have been rejigging their service networks to try to mitigate their own exposure of vessels that would be clipped by the USTR. So I think, you know, it feeds into the sort of disruption definition that I mentioned earlier, which is, at least in the near term, it's actually helpful to tonnage providers like us. There's been disrupted networks, disrupted trade flows, rejigging, and all of this helps if you're providing tonnage into the space. And that's precisely what we've seen. We've seen that despite the fact that freight rates for the liner companies themselves have been under some downward pressure, really for the last month or two, charter rates for mid-size and smaller container ships have actually held up really quite well, which is curious. It's sort of counterintuitive that you would see those markets disconnect for a sort of a fairly sustained period. And I think what explains that is disruption, scarcity value in the charter market at the moment, and the fact that, going back to the point I made at the outset, for liner companies, capacity is optionality, and everyone is looking for optionality to manage a highly uncertain world and an increasingly uncertain world at the moment. So once again, how all of this plays out and how it affects you very much depends where you're sitting in the chain. And for us, so far, it's been a positive.
Tom, you'd anticipated my next question about the disconnect between freight and charter rates. We're into the fourth quarter now. We're into 2026. Do you anticipate, I mean, the freight rates are down almost 60% year to date. Do you anticipate the spread between freight and charter rates to be maintained? I mean, a liner company announced last week that they had chartered 5,000 TEU vessels at very healthy rates for 3 years. So There seems to be an appetite out there, but how sustained is this spread? Or do you feel this?
Yeah. Well, I guess we're in one of those so far so good situations. What tomorrow holds is anybody's guess. I think it would be unlikely that the disconnect would last indefinitely, because both markets at the end of the day are driven by supply-demand tension. So one would expect the two to converge over time. How long that will take, I simply don't know. Black swans seem to be coming in flocks at the moment, so it's very, very difficult to pencil out that scenario.
If I may, can I throw a comment on that?
Absolutely.
That's very correct, that the disconnect cannot last for very long. And I think that will be seen first, that the reconnect will be seen first on the rates for the larger ships. Of course, most of the larger ships are on longer-term charter, so it might take some time to see it there. But there would be the first sign of reconnecting freight rates with charter rates. The point I want to make is that the feeders, they serve the long-haul trades. So irrespective of whether the long-haul trades are profitable or not, as long as the volume is there, they need the feeders, the smaller ships, to serve them at the two hubs, the loading and the discharging hub. The supply-demand situation for the feeders and intermediate ships thus is very different from the overall, because the trade volume supports demand for the feeders at the two ends of the long haul, irrespective of whether there's overcapacity in terms of supply on the main trade. So there could be that the charter rates for large ships come in sync with the freight rates, but definitely our hope is that charter rates for the feeders and intermediates would develop their own dynamic and remain and reflect that supply-demand situation.
And if I may, Liam, add to that, one thing we haven't mentioned on this panel is that charter rates for companies like Tassos's and mine, they tend to be comparatively long-term, by which I mean, 2, 3, 4 years, which allows us to lock in the good times for 2, 3, 4 years, which is great news. Now that puts us at an advantage over the liner companies, who tend to be far more driven by the shorter-term market, the spot market. So for a liner company, a year is a long-term contract. So I think that's another, perhaps, explanation for this disconnect, is that there's structurally going to be a lag between when the softening market hits the charter market, simply because liquidity in the charter market is so limited, which is a good thing for us, and secondly because the charter durations are rather long, so you lock in the good times.
Thank you. Bill? Yeah.
Let me go back very quickly to the port fees. I think it should be noted that in terms of the United States fees is concerned, it's unlikely to affect the service levels in and out of the United States. All of the non-Chinese operators have already moved all their Chinese-built ships out of the U.S. markets. They've also said they're not going to charge a fee, and COSCO, O, the Chinese operator, has already said they're not going to change their service. So relative to service levels in and out of the United States, the port fees in the U.S. are unlikely to have any kind of material negative impact on the service levels. The whole China thing is a whole different ballgame. I mean, you're peeling back the onion and finding out more all the time about what it's going to do. We're going to have to wait and see. In terms of the charter rates, I'm not involved in the charter business, but I have been closely involved in the rate levels. And the rate levels today have gone down for the last several months. They are now, in aggregate, container rates around the globe, if you took a look at it in aggregate, are back to where they were, or even below where they were prior to COVID. And if you look at rates prior to COVID, they were roughly in the same area for 10 or 15 years. And in those 10 or 15 years, the ocean carriers were making small single-digit margins, operating margins, either negative or positive. And we're back to that area, and even lower, and I can't imagine the spread between charter rates and what the carriers are taking in terms of rate for their cargo being largely different for very long at all. I mean, if you're taking in X and you're paying out X plus something else, that's going to be a big problem. One last thing I'll mention on uncertainty in the business. I think Tom is right. This uncertainty has been good for asset owners. If you look at, for example, COVID, or take COVID, take the 21-22, and if you look around the industry, you'll hear people talk about the fact that the carriers made more money in 21 and 22 combined than they did from 1956 until 2019. To give you an idea how crazy it was, I mean, it was beyond. And then the carriers got another blessing, which was Suez, which has kept rates up as well. So, but I can't see this differential between charter rates and freight rates lasting for very long at all. It just doesn't make a lot of sense to me.
If I stay with you, Bill, and just as a follow-up on that, if I look at pre-COVID as a normal, relatively normal time for the container sector, you had steady growth. You had charter rates, which are fairly low, but people were making money. If we flip now and sort of take the distortions out of the market and go back to those pre-COVID levels, do you anticipate some stress in the sector?
You know, it depends what you, I mean, the first thing I get asked by customers and other people with that sort of exact question is there going to be further consolidation? And I really don't think so. You know, will it change service levels? Maybe. I don't see it, as I said, affecting consolidation, given if you look at each individual carrier, you can make a case why they're going to be around, whether it's in Korea or Taiwan or China or wherever, Denmark. I don't see the number of carriers changing through consolidation. Remember, this business went for 50, 60 years earning, 2, 3, 4% on their money. Maybe they'll be comfortable going back to that. I don't know. But I honestly don't see it necessarily changing a lot in terms of the industry structure, people falling out, consolidation, et cetera.
Thank you, Bill. We touched on the order book. We touched on potential scrapping, aging of the fleet. And we talked about how the order book on the 10,000 and below TEUs is much more manageable than the total, what we'd call a bloated container vessel order book. So starting with Anastasios, could you tell us how you're managing the fleet in terms of renewal, in terms of buying and selling vessels, and with all this going on?
Sure. I mean, as you mentioned, as it was mentioned, the COVID and the disruptions that created changed the fate of the sector. We were able to conclude medium and longer term contracts after 2020, which secured certain cash flow levels for us. And on the strength of those contracts, Euroseas embarked on a significant renewal program. We ordered 9 feeder ships because we were committed to that sector. We identified that the needs were there, and completed that program earlier this year, and started a new building program. Ordered 4 ships now. At the same time, we took seriously the environmental regulations and built on our desire to be good global citizens. So on the medium-age ships that we had, we embarked on retrofitting them, achieving significant reductions of the fuel consumption. So this is how we're using the opportunity and the financial strength that the markets bestowed on us to make Euroseas a greener company with very young fleet and growing. So this is how we deal from our side. I want to reinforce the comments all of us made, at least the 2 of us made earlier, that the feeder sector, intermediate sector, anything below 8 or 10,000 TEU is way underbuilt and with a lot of old ships, and there appears to be a green future for that sector.
Tom?
Yeah, well, I mean, I'm going to open with a sort of parenthesis, just to underline the fact that the 2, 3, 4% returns that Bill was referring to referred to the liner shipping sector,
Yes,
not
refer
the
to
ship
the liner
owning
business.
sector. So I can reassure those investors in the room that container ship owning tends to deliver rather richer returns than that. But listen, I mean, the cycle and volatility through the cycle and the pressures of overcapacity at one stage in the cycle and the pressures acting in the opposite direction of undercapacity at other stages in the cycle. That's the ball game. That's exactly why we're in shipping. You know, we're here to manage the risks of the cycle, but most of all, we're here to capitalize on the opportunities offered by that cycle. So, I mean, we ran these numbers a little while back, but if you were to buy into GSL stock towards the bottom of one trough and sell out at the top of another, you'd be looking at total shareholder returns of 1,300%. So that's why shipping, that's why this cyclical, volatile, unpredictable industry is at the same time potentially very, very attractive if you're playing your cards right.
It's a bit more predictable now because of the long-term contracts that I guess both of us have. I mean, we have pretty good revenue visibility for at least the next 2 years or even longer. And at least at Euroseas, we feel that we set our dividends at a level that can be sustained, I wouldn't say as far as the eye can see, but in the reasonable future.
Bill, I know you don't operate vessels.
Yeah, no, but let me add one thing that relates to that same topic is maybe on the positive side from an ocean carrier perspective is they've become better over the years at managing capacity. The biggest change has been something called blank sailings, where you simply cancel a sailing. It doesn't change the number of ships, it just changes the capacity available, and they've become much better at doing that. I think a lot of people expect a lot more tonnage to be scrapped in the next 10 years for various reasons. The fleet is pretty old. With new greenhouse gas regulations, it's undoubtedly going to drive more of that. But the carriers have definitely gotten better at controlling capacity in a marketplace that is where rates for the carrier and shipper contracts are entirely driven by supply and demand. It's a commodity product. It's an efficient market in a technical sense, but they have gotten better at managing the supply curve. The demand is lower than it has been historically, demand growth, but they have gotten better at managing capacity.
Thank you, Bill. We only have a few minutes left, and they changed the number on it. It went from 2 to 6, so I've got plenty more here if we want to keep going. Let's talk about capital allocation. We'll stay with Bill and then come back towards me. You're an asset-light model.
Yeah.
You have different priorities for capital. We were talking about fleet management here, so we'll start with Bill and then move Tom to Anastasios talking about capital allocation.
I mean, you know, I think our capital, if you can, whether it's a small c or a large c, is people. I think that's basically what it is, and technology. Again, we're asset light. We don't own the ships that we move cargo on. But what we do, where we do apply, we would talk about capital would be basically our people and our technology in terms of facilitating the movement of the freight and making that supply chain management for our customers a lot more effective and efficient. So I would just say our view of that would be our people and our technology being a process that allows a customer to, I would say, in this day and age, to create a resilient supply chain. If you're a person shipping cargo and you've guaranteed to your marketing people it's going to be delivered 98% of the time, where they want it, when they want it, the right quantities, you have to have a resilient supply chain today in this business. If you don't, you're going to be toast, just the way the business operates. And I think what we do very, very well is enable clients to create a resilient supply chain, so you don't have to worry about the fact that you've told the marketing people that you're going to deliver their stuff 98% of the time, where when they want it, when in fact the ships are on time 65% of the time. So if the ships are, we translate, we get them from 65% of the ships being on time to being able to deliver their cargo 98% of the time, where and when they want it. And that's basically people and technology.
Thank you, Bill. Tom and Anastasios, both of you have dividends payable through the cycle. Very comfortable at the levels, generous yields. Fleet renewal is a priority. After that, can you talk about how you're allocating your capital?
Should I go first?
Oh, yeah, happy to kick off.
Tom,
I mean, our... Sorry?
Go ahead, Tom.
Our capital allocation is dynamic. So we've talked about the cyclicality of the industry, the volatility of the industry, and the fact that obviously the risks and opportunities change depending upon where you are in the cycle. And if the risks and opportunities are changing, then your allocation of capital logically changes to either manage the risks or capitalize on the opportunities. So at the moment, we are paying a dividend of $2.10 per share, annualized, which we upsized in effectively 2 tranches from $1.50 per share over the course of the last, 18 months or so. We have also executed share buybacks when we felt it made sense to do so. And of course, being at the opposite end of the sort of the asset spectrum to that which Bill has just described. So we are ship owners, which makes us asset heavy by definition. And clearly, if you're asset heavy, that requires capital. So fleet renewal, given that ships, cash-generating assets don't live forever, you have to invest in replacing those assets over time. And it becomes a question of choosing the right moment in the cycle to invest in assets where your downside risk is limited and your upside potential is as juicy as possible. So we pivot between the risks and the opportunities with our allocation of capital in the way that makes most sense as far as we're concerned, driven by the context at the time.
Likewise, we're in a good position to have capital to allocate. As you mentioned, fleet renewal and making the fleet more efficient is our #1 priority. And we're trying to balance investing versus returning funds to our shareholders. We also have a dividend that is about 5% annualized yield, $2.8 per share annualized. We have a share repurchase program which we execute when we feel the share price is sufficiently low. I think all the companies, unfortunately, that are public trade below what we believe our NAV is. Our share price improved recently, so we're at a better multiple. And we do the new building program, and of course, we want to have funds available to capitalize potential opportunities. I think if some of the less positive scenarios come around, then there will be significant opportunities to invest at much more attractive asset prices. So we want to be prepared for that. The reason we think we did well in 2020 is because we had ships on the water. You have half of the success in shipping is to be there when the upcycle starts, and that happens very quickly. So we try to be prepared for that potentiality as well.
Yes, if I can just add to that very quickly, Liam. One thing I think that all of us in the ship-owning sector have learned is that when the opportunities are most attractive, that's when capital is least available, because basically the opportunities to invest in new assets are most attractive when there's blood in the water, at the bottom of the cycle, when everyone's fearful. That's when you need to be in a position to invest. That's why it makes sense to have a balance sheet that is supportive of making such acquisitions when capital is otherwise not well available. So I think that dovetails with what Tassos was saying.
It looks like we have run out the clock here. I cannot thank you enough. This has been a great panel, but I'm biased. One of the best we've had today, and thank you, and appreciate it.
Thank you very much, Liam.